The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that theme means it is time once again for Volatility Views. It feels good to hear that theme song. We haven't heard it in a while. We, of course, have been on hiatus for a little bit. Listeners, many of you have noticed. You've been writing in saying, where's my Vol Views? I need my weekly Vol Views fix. Well, we're back, and we're here to give you your weekly dose of volatility and volatility analysis. My name, of course, is Mark Longo from theoptionsinsider.com, as well as the ever-expanding, ever-evolving Options Insider Radio Network. And my usual cohort on this program, Mr. Don Schlesinger, is off gallivanting through France on assignment. But we do have an able replacement ready and waiting in the wings, none other than Bob Kraus, the CEO of the Volatility Exchange. Bob, welcome back to the show. It has been a while.
Thank you. Welcome, everyone. I'm a little under the weather. I hope I don't sound like a frog, but, I'm feeling good, and I'm very happy to be on the show and back on Volatility Views. It's been a couple of months since I've done the show, but looking forward to taking over.
Yes, I believe since we delved into the land of commodity vol over there at the Board of Trade, that was pretty interesting.
Oh, yes, I remember talking about that. That was nice.
It was nice. And speaking of nice, not a word often associated with him, but he is here nonetheless. He is none other than Mark Sebastian, the Director of Education over there at OptionPit.com. Mr. Sebastian, welcome back to the program, sir.
You know, I'm doing awesome, Mark. The world is my oyster, and you are my shell, if that makes sense.
That's both comforting and a little disturbing at the same time, so thank you for that.
Yeah, no, I'm feeling great. I'm looking forward to talking about gold volatility today.
Got to find your vol somewhere, right? So we'll find it in gold. You got to find it,
and it is in precious metals, where vols are exploding, realized and implied.
I think that's a good note to roll on into the volatility review on, wouldn't you say?
I would, my good sir.
All right, then. To the Volatility Review, we shall go.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. If you are just joining us for the first time, first off, welcome. Secondly, shame on you for missing so many great programs. Go back and download them immediately. 2 years worth of archived Volatility Views programs for you to enjoy. A lot of great guests. But if you are indeed joining us for the first time, this is the segment of the show where we look back on the weeks, or in this case, perhaps several weeks worth of volatility action. And Mr. Sebastian, since you got the ball rolling with gold, perhaps we'll start there. What really caught your eye in the realm of gold implied and realized vol, sir?
Well, gold is off about 4% today. It is getting absolutely crushed. And with that, we saw a which is a big move. Then you're seeing a similar move in silver. Silver's off about, 4.5%. And then their vols, if you look at kind of the GVZ, which is gold vol, over 19% now, which, after reaching a high, gold vol printed up to 22.5. It was a massive vol spike in gold. And then the silver equivalent, VXSLV, which, and I understand these aren't the futures, but they correlate so well with the actual physical that you can use them as a proxy. Was up about 5 points, and reached a peak today at 31%. Just huge moves in kind of SLV and in gold and their vol equivalents. Realized vol exploding in both products. Money is leaving gold and entering bonds and entering the stock market. And so that's why you're seeing bond vol getting smoked. And but stock market volatility has finally found a floor, let's say. If you read my blog last night, as I know Bob does every day. Bob, two things Bob reads every day: the Wall Street Journal and my blog.
Absolutely.
So if you read my blog, one of the things I made a nice argument based on vol views, actually, about kind of this, how wrong implied vols usually are, and about the spread, and based on the wrongness of implied volatility and kind of the spread between those, I think the VIX is going to have a tough time getting an 11 handle anytime in the near future.
Yeah, I mean, we're looking, yes, as we're recording this, listeners, right now, it is middle of the session here on Friday. The S&P leading the charge, down about 0.5%. Of course, not compared to gold, down about nearly 4%. And the other major indices somewhat lagging behind that, I should say, with NASDAQ down about 0.4%, Dow down fractionally on the day. VIX cash creeping up ever so slightly given the massive sell-off, up about 0.3 of a point today to 12.54. And I agree with you, Mark, given the movements we've seen just in the major indices alone over the past few weeks to the upside and, of course, to the downside. And on this show, we tend to count upside moves as well, not just downside, like everybody else. We don't just play that halvesies game. We count the full vol. It's hard to really see an 11 handle making much sense in the VIX cash anytime soon.
I agree with you. The one thing Andrew and I we've kind of changed the Bernanke state. People say it's the Bernanke put. Andrew and I are saying it's more now like the Bernanke straddle, because there is an increase in speed, and it's directly related to, I think, money flows. And so you're now seeing the Bernanke straddle in full effect, and you're seeing the market. I think the market is going to be moving closer to $10 a day, which is still not a super high vol, but definitely better than where we've been.
Yes, that was a hot topic of discussion on yesterday's option block. And listeners, if you don't listen to that show, I recommend you tune into there as well. The money flows coming in from Asia and how they're sending us on this wild ride that we are currently on. Interesting stuff. I recommend you check out yesterday's option block if you'd like to hear more about that. And Bob, what has been catching your eye in the volatility realm since the last time we spoke?
Well, I just wanted to comment kind of on, or follow up, I guess, on Mark's analysis of gold. And it's very interesting. Right around the 1st of April, so just about, 12 days ago or so, we hit the lowest realized volatility in gold that I have charted. So, and I think that goes back to forever. So,
really?
Yes.
From the day the Earth was formed, you charted gold vol that. Wow.
Not much implied vol in those Roman days for gold, really.
And basically since April 1st, the volatility has been just spiking, and I can't wait until the closing value today to see, where that really jumps up volatility. But the vol of vol, so now how volatile is volatility itself, right? And the vol of vol is around 170, and that's just as of yesterday, not including today's huge spike. So I think we're going well over 200 in the vol of vol space, and that is, approaching like I don't know about all-time high. I mean, it gotten up to 300 way back in 2000, but we're up in the nosebleed section, certainly, as far as vol of vol goes, that the change in volatility is just immense, and up to a high that it's only been achieved a few times before.
That's a stunning level of volatility to go from all-time record lows, forgetting the Romans, all-time record lows, to approaching, if not all-time highs in such a short span of time.
The problem with I get that. The one problem with vol analysis, and this is kind of one of the things I think is important to note, is that, because we're dealing with volatilities, right, where a percent is a percent is a percent. Moving 1% when we're at 10 vol is just as easy as moving 1% when we're at 20 vol or 30 vol. It's more of a hard number. So, just because all of these indexes, when they get low, I think you're going to see kind of the same thing, because when the VIX or the GBZ or the NASDAQ Real Vol Index gets to these 10, 11s, 13s, 14s, it's still going to be able to move 1 or 2 points with ease. A low Real Vol number does not equate to, something is screwed up if we don't see vols at near all-time highs when these Real Vol numbers hit these near lows. What do you think?
Yes, you're absolutely correct, and that's why if you look at interest rate products where the volatility of T-bills or something is like super, super low, right? But when something moves, boy, it just, the volatility of that volatility is just immense. And so what's interesting is that, a lot of people think, well, I'm not really interested in trading a volatility product on interest rates because, the volatility is so low. And my counter argument to that is, well, yeah, but when you trade the volatility on interest rate products, then what you're really interested in is the vol of vol, and the vol of vol of interest rate products are the highest of any other product. And
yeah, so, there's a reason why the euro-dollar pit on the CME, the euro-dollar option pit on the CME floor is packed.
Yeah, exactly. So, I am very interested and excited about the day we can launch a volatility product on an interest rate. I think it's going to go gangbusters, a lot more than anybody imagines, because nobody's ever tried it. Even the VIX has kind of stayed away from interest rate products. So, they've tried launching on things like gold and crude oil and stuff like that, but nobody's even contemplated an interest rate product, and I would just love to launch it in that area.
It's funny, going into realms where even the VIX has fared to tread, Bob. I like it. Breaking new ground. It seems like there's no product or asset class in the world that the VIX hasn't tried to commoditize to a vol perspective in some way, shape, or form. So.
Well, and the funny thing is that there's actually demand for that product too.
Particularly now.
You don't think that pension funds and annuities and things like that have these kind of defined risk things wouldn't love to have a product like that?
That's what I'm counting on. Yeah.
I think you're right 100%. I know for a fact that they would. So I agree with you, Bob. I agree with you 100%.
And Bob, we love to talk about gold and vol here, but what about, I know you guys are in the process of finalizing your NASDAQ product, so what have you seen in the realm of NASDAQ over the past week or two that's really caught your eye from a volatility perspective?
Yeah, well, I'm looking at right now the S&P, and it kind of jumped up a little bit as far as realized vol, but it's that's just in the last week or so. But I would say it's kind of normal, right around the 10% range. And then to look at the NASDAQ perspective, it kind of looks the same. It spiked up in the last week, but that sort of brings it back into the middle of the range. If you were to look at a chart over a year, there are lower, definitely lower spikes and higher spikes, and we're kind of now back into the middle at, around 12 or so as far as realized vol goes.
the scintillating world of NASDAQ volatility. I think with that, we're going to close out our volatility review for this episode and keep on rolling right on into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that jaunty little tune means it is time once again for our Volatility Viewpoint segment. I know you guys out there love it when we bring guests onto the show, so we have accommodated you once again. Today's guest is Shreyas Chari. He is the principal at Satwic Capital Partners. Shreyas, welcome to the program. We're glad we could finally get you on.
Thanks very much, Mark. Thanks for having me on.
Shreyas is joining us via the magic of this new technology called telephone, listeners. So if he sounds a little bit distant, that is why. But Shreyas, why don't you go ahead and give our listeners a little bit of an overview of your background in the options and volatility realm?
Sure. I started trading at CIBC about 13, 14 years ago. I started on the exotics and the structured products desk. Subsequently moved on and was at Deutsche Bank on the correlation desk and ran North America single stock variance as well as global correlation. We traded proprietarily globally and customer facing in North America. Traded a number of markets, traded a number of regions and sectors, and ran that through a pretty large diversified portfolio, trading vol. And now I'm the founder of a small fund called Satwic Capital, and happy to be on the show. Talk to you guys.
Tell us a little bit about that fund then. I know it's relatively new. You just started it back in July, I believe. So what is the focus of the fund, and what are you guys trading over there?
So the focus of the fund is basically just pure relative value and utilizing vol. So again, I stick to I'm sticking mostly to ETFs, and due to there's always mispricing, as a lot of people know, a lot lesser than it used to be due to the lower vol of vol as such, and the lower vol levels that we have right now. But typically, sector rotation or regional rotation always brings about some dislocations, minor or major, from time to time. And the focus of the fund is to have an uncorrelated return to markets as such. There's no directional bias at all in market in being long or short the market. However, it is long and short vol with very little residual outright volatility positions as well. So the idea is to trade mispricings across different sectors or different regions, and have a portfolio that can exceed the normal expectancy that the market has, and have a positive expectancy throughout. So there'll be times when you're long certain spreads and times when you're short certain spreads. And if these spreads are actually in the portfolio at the same time, that's even better because it reduces the overall volatility of the portfolio as well. And that's pretty much been the goal. So with lower vol levels and as I mentioned before, there's obviously fewer opportunities. I would say the market is very fairly priced across a lot of sectors, but every now and then there are some dislocations. So the fund's goal is to capitalize on those dislocations and not have an outright bias.
So Shreyas, you're basically doing swaps. So you'll have a long or short gamma position in equities, but the meat of the position or your kind of global position will be relatively flat, and you're trying to take advantage of over/under price volatility. Is that kind of the approach that you're using?
That's exactly right. So in some cases, correlation is a good measure, but it's not the only measure. So we use a few statistical measures, obviously, to make sure that we have a high probability of success. There aren't too many trades on at any point in time, but they act as long and short gamma or long and short vega, whichever way you want to look at it. Typically, I'm in the 2 to 4 month range Very infrequently am I in the longer dated range, especially because of lack of volumes. I mean, most of the option trading volume seems to have shifted to the front end of the curve rather than the back end. And so I'm capitalizing on movements between sectors and regions. I think.
Yeah. So.
Shreyas, this is Bob Kraus here, and I had a question for you. You mentioned correlation a couple of times. Are you really trading correlation per se, or just kind of looking at it as an indicator to take on, your volatility or positions?
Sure. No, so most of my history has been trading correlation actively via dispersion or even just outright correlation products. But no, that's not what I trade right now. Correlation I just use as an indicator, as a level to give me an understanding of of how fairly something is priced. It's more as an indicator rather than anything else. I'm not particularly trading correlation.
Now, Shreyas, you picked a good time to come on the show today because my usual co-host, Don Schlesinger, is not here. He is known as something of a premium seller. So with him being out of the way, we can finally discuss the long end of the spectrum, or the potential for buying some vol, buying some gamma. I know one of the things you wanted to hit on today was gamma and its relative value right now in the marketplace. I believe you are somewhat a proponent of being long gamma in here. You think it's relatively fairly priced. Why don't you explain why you hold that belief here to our listeners?
Right. No, actually, I'm not a proponent of either buying or selling volatility just on an outright basis. I don't think that I can consistently judge where anything in the world is going to go. However, I'm probably somewhat competent at being able to judge the relative pricing. So from that perspective, owning volatility or owning gamma has been the death knell for a lot of people, I'm sure, especially with realized vol being so low. So owning volatility just outright is clearly not the smart way of doing things, especially in this market, because while you may say that there is always the possibility of a 3 sigma to a 6 sigma move, waiting for it can bankrupt you. So the reason why I'd mentioned gamma before, I mean offline off this podcast, was that I had started seeing some value in owning specific places, owning gamma in specific places. So as an example, what I did was I'm constantly looking to see what is the most efficient option in the market. Which by that what I mean is what option, or in any term or in any asset, bleeds the least, can carry the best. Typically, low vol stocks or low vol indexes which are realizing the same amount, in other words, where the vol risk premium is very, very minimal, are typically expected to carry better than other assets which have greater vol risk premium. I mean, it's intuitively appealing, and it sounds just about right. However, there's a big difference between what strikes and what terms you really need to own, even in those assets, because it makes a big difference. As we trade fixed strike options in the exchange traded market, we're highly path dependent. We have, our P&L is very path dependent. So it's important to figure out what is the most efficient option, given the fact that there is some degree of path dependency in this market. So having done that, surprisingly, the conclusion that I reached was something that even I didn't expect at all, was that I found that shorter dated downside in the S&P carried better than almost anything else in the marketplace, especially over the last 2 to 3 months. Now, again, by that I don't mean that it's going to make you a killing. It's clearly not going to make you money. But again, the objective of long gamma in such an environment, or long optionality in such an environment, is to protect you against the events that you've not foreseen, or it's just a form of portfolio protection. So VIX-based options and all of these other and ETNs based off of them are highly inefficient, and they continue to remain inefficient from a protection standpoint. But within the S&P itself, I found that the shorter dated lower strikes were actually somewhat effective in carrying. As an example, from January through March, you could have carried it at break even. Whereas if you'd owned any other options, even at the money or upside or in any other term other than 1 to 2 month terms, you would actually be losing a significant amount, which would be proportional to the vol risk premium. In other words, implied vol minus realized vol, roughly speaking. S&P was one of those places. Upside in bonds was another place which carries very well. Upside in bonds is typically a risk-off trade. You buy upside in some things like TLT or just outright in the 10-year bond space. If you're going to buy upside in that space, you're typically replicating a risk-off event because it's a flight to quality. When you look at those options, you find those are actually somewhat underpriced. That's another more a more novel way of protecting yourself rather than just buying deep out of the money puts in the market or buying VIX call options. So I guess the gamma pod that I'm talking about comes from actually looking at what strikes and terms carry the best, and that was my conclusion.
Really? So when you're talking about shorter dated stuff, are you saying a couple of months out? So you're saying it is more efficient to hedge with an option with 60 days to expire than an option that has a year to expire?
Absolutely.
Really?
It's carrying very well. I haven't gone out to the 1 year term, actually, to be honest. I went out till between 6 and 9 months. And again, it wasn't as if at the money was carrying that well, or even the upside. There was a time when upside was cheap, when the market was below 1,500, when it was not pricing the upside very efficiently. That's changed now, so that's being priced well as well. So typically when you see that, when you see that kind of a shift, you find actually, there's obviously, let's not forget, the market's trending in one direction, right? So typically when you're trending like that, the fixed strike notion matters even more. If we were in a choppy market right now, it would be way easier to hedge gamma or to be long gamma, because you could pretty much pick most assets that you thought were cheap just on a very naive implied minus realized basis and say, okay, I like this guy. He's only, it's a 20 vol product and it's 2 vols costly. That's 10%. And here's a 30 vol product and that's 1 vol costly. That's 3%. So I like the 30 vol product to be long gamma. And you could do it naively at that point because it's a choppy market. But that's not the case here. So in a trending market, especially when everything is trending in the same direction, other than commodities and bonds, let's say, which are naturally skewed to be on the other side in this cycle, except for those guys, you see that pretty much when everything trends, what is the most efficient option to own? So it turned out that was the case. In fact, I'm going to bring up another one in the least effective, just to see what was the least effective on the other side. I could see that Russell was routinely overpriced in vol terms, and that was across every term, across every strike.
Oh yeah, Russell's been overpriced for it consistently. The spread between realized and implied in the Russell and the Nasdaq has been, and the NDX has been. It's so wide you could put a truck through it. Meanwhile, S&P and Dow is priced pretty efficiently.
Exactly. So I would agree with you. That was my conclusion as well. I found Russell routinely overpriced by about a whole vol. I found Nasdaq overpriced across the term structure by 2 vols. I found the downside overpriced by almost a vol. But I found Nasdaq upside is ridiculously overpriced, at least in gamma term. What else did I find? I found, as a corollary, I found bonds downside very expensive as well. In fact, that's something I've been trading in my book as well. And gold downside as well as being very expensive. In fact,
well, I think people today will tell you maybe gold downside.
I think gold's pretty fairly priced today. You missed the opening segment, Shreyas. We had a long talk about gold, vol, and this big downside move we're seeing in gold right now. So perhaps today is one of those aberrant days that makes that overpriced vol look cheap.
Yeah, actually, it's by gold being overpriced. I didn't mean gold vol was overpriced. I meant that gold's Q was pretty high. So even with a 3.73% move, which is what 3.5 standard deviations right now, is you still wouldn't lose money on being short gold's Q on a 3 standard deviation move.
Wow.
So it's, again, gold it's a tight vol product, typically. So it's not as if you can expect to make a whole lot of money. But I guess what I'm saying is, empirically, from what I have seen so far, the downside is still expensive. I'm pretty sure even if I put in today's move, it would still be the same. But there you go.
Oh. Shreyas, you talked about, say, 2 month versus 1 year, or 2 month versus 9 month. Did you even look at like even more extreme, like the weeklies versus a 3-year option kind of thing in the S&P?
Yeah, the weeklies. You see, the thing with the weeklies is you've got to like move away from vol, right? It's not really vol at that point. So it's tough because you look at a weekly option and it loses 20% of its time value every day, right? So it's like it's difficult to come up with that transformation, what I call, between vol and profitability. At least with real options out in the 2 month or to 1 year, let's say, options, you can actually make that transformation and say, this is how your Vega is coming into. This is how your Vega is transforming into profits or losses. So, so with the weekly options, what you have to do is, you can run the same exercise for efficiency. However, I have not done it. I think that task is a little bit more complicated than the way I did this exercise. I will probably do it at some point soon, though.
So now, when you're doing these correlation trades, have you found what's been kind of the trickiest part of it? To me, it would be, if I was doing something like that, my issue would be, okay, how do I hedge these products? Do I let them run, or do I dynamically hedge, counting on the vol, to just vol performance? That would be really kind of, I think, one of the big stumbling blocks I would have.
Right. So I'm not doing correlation trades, but I guess you probably mean the fact that I have long and short vol, therefore.
Against each other, yeah. How do you manage the short and gamma at the same? Yeah. So you've got one product that's short gamma, one product that's long gamma,
right.
And one that's overpriced, one that is relatively underpriced. Do you, if I had a trade on like that, the question I'm asking myself is, okay, do I count on the gamma of one outperforming the other, or do I dynamically hedge, or do I count on the one, the long or the short, the relative performance, and let them both run? That would be a tricky decision for me.
Right. So typically, the bigger problem is not that. I would say that the bigger problem is your Greek deterioration. So in other words, you start off at a certain, let's say your flat Vega, just to keep things simple. So you got, long 1 unit of Vega, short 1 unit of Vega. The problem arises when you have, when you float away from the strike on one asset versus the other. So that will then move your Greeks, out of whack, and you're going to be too long or too short at that point. So I would say that's a little bit more challenging than the choice of how to hedge them, because the premise of the entire premise of doing the trade is the fact that here are two fairly well correlated assets. If their correlation drops, I've actually got more trouble than that's actually a bigger problem. And if correlation drops, it's essentially meaning that one is going the other direction than the other, or one has gone too far past the other, where your Greeks become imbalanced. So there's two parts. So the hedging part I do on a very daily basis. Wherever I have a net gamma move that is worthwhile, I am trading both sides of that gamma, and therefore rebalancing myself. On the actual Greek drift, or the spot versus strike drift, I have to constantly monitor to make sure that the dynamics of the trade still stay alive. If they are still alive, then I rebalance by buying and selling options to move it back into line of where at the money is, or whichever part that I'm trying to monetize. It could be I'm trying to monetize 25 delta options, the downside, or 25 delta upside, or at the money. So whatever the thesis is, to keep it simple, if I'm long and short at the money vol, I have to keep it long and short at the money vol as long as the trade, the thesis, the vols are still in line when I put on the trade. So I guess that's a long-winded answer, but yeah.
Shreyas, I think you've blown all of our minds here today with your. I think if you polled all three of us today about where we would think the most efficient use of capital, the least decay, the least histrionics would be in a long option position, near-term, short-dated downside S&P puts would not be the place I think any of us would have chosen. So that in and of itself, I think, is a pretty interesting development. Now, what do you think about some of this research? First off, I think all of us here on the show pretty much agree with you. We kind of tend to prefer the direct hedge approach, the downside put spread, whatever the case may be, versus let's say a vol product like a VIX call to hedge a broad index portfolio like that. But what do you say to some of these people who are throwing out research these days that are saying, yes, the S&P, the direct hedge does outperform on a general basis, but when you have these crazy Six Sigma moves, these aggressive move days, that's when the volatility product dramatically outperforms anything else. And if you look at those and you incorporate those results into a 6-month or an annual basis, you have a few of those days of pop, and you can weather the storm in between. You can actually outperform somewhat dramatically sometimes using the indirect or the volatility type product as a hedge.
Sure, you can. I mean, I'd be the last person to argue against that, given the fact that we've had, 5 crises in 5 years so far. So, it does tend to blow up. My only point to that is everything has a fair value, right? So if you have one outcome of the wheel that is going to be a 50-time payoff, and 49 other outcomes of the wheel that is going to cost you money, there's a straightforward way of coming up with what the fair value should be for that 1/50th piece of that wheel. Unfortunately, I think that the VIX is overcharging you for that. So I would say, yeah, you're right. I mean, if the crisis does hit, it is there. You do get that, and you do get that massive payoff, and it looks great. But for the most part, it doesn't. So it's what I call negative expectancy at that point. So the question is, what are you looking to do? Are you looking to get? Are you looking to benefit or hedge a catastrophic event? And if that's the case, then yeah, the VIX would be the way to go, and these deep out of the money options in the VIX would be even better. Know that it is a cost to you. So once you've defined that cost, then go for it, because you pretty much know that in this kind of an event you have a 10 times payoff or 50 times payoff. I would say that's the best way to trade it. In other words, don't overthink it at that point. At that point, it's just a question of premium. But if you come to how most of the world works, I mean, most of the world is not exposed to the market collapsing by 25 to 30%. If they are, then they are probably too long, in my opinion. So I would say, like, more reasonable people who are trading an actively managed portfolio, I think should not focus on the fact that they're trying to protect themselves against every massive liquidity shock or every massive Six Sigma event. I think they should build that into their portfolios by having tactical hedges, by monitoring their risk, by having some degree of optionality protection, and that you have a defined cost for. So it's a combination of a whole bunch of things. If you can do that, then you don't have to go out there and pay a 10% premium per annum to protect your book against a massive fall in the marketplace. And so I'm just saying it's a question of utility, right? So I think people should define the utility a little bit better. That way they know which product serves them better. And I think a lot of people fail to do that, which is why you get these crazy bids in these vehicles from time to time.
Well, Shreyas, it sounds like you've been listening to this show, because I think you're echoing our sentiments exactly. So I'm glad to hear that, at least.
We're all in this marketplace. We know what we can probably see, for better or for worse, where there's value. So I'm not.
Mm-hmm. Yeah, no, that was really fascinating. I have to say that S&P near term. You know what? Yeah, here, it's got to be put sellers that are forcing the curve down. This kind of put selling again in the SPY, or kind of the put selling fund approach that it's driving that near term skew down. So many traders are taught, you take advantage of that exploding decay in the last 60 days, and it could be that that Shreyas is hearing the sound of a million ants jumping at once, if that makes sense.
Yeah, it certainly could be. I mean, we do see these put-selling programs even on the weeklies, right?
The weeklies, and that drives everything.
That does, right? That does. Absolutely.
And so, you get all these newsletters, fund managers, individual traders, everybody dumping these weeklies and monthly out of the money puts. Maybe that's what that's driving his short-term data. You were saying 60 days is the one you were looking at?
Well, from January to March, I was looking at April and May. So the fact that we're in April, just add about 2 months from now. So I would say, June onwards. Now, if you look at it, it should.
Wow.
Again, skew is low, so it's not as if I'm.
No, I agree.
Out of left field on that, but skew is low. But again, skew has been, being short skew 6 months to a year usually pays out. But
yes.
The problem is, of course, if you don't rebalance because of the fact that the market keeps drifting up. So I think what's happening is that basically the market's drifted so far up that as such there, the greatest demand for all these puts that used to keep skew up has reached a point where it's no longer. It's funnily enough, as the market goes up higher and higher, you would expect there'd be greater demand for protection. But, when that's not happening and when the reverse is happening and you find that these options can carry better, that just tells me that it's not a question of a lot of people even having that much exposure. I don't think they have that much exposure to anything. And, it's a pretty hated bull market. I mean, if you saw the latest sentiment figures, even in the AAII figures, I mean, it was mind-blowing. I haven't seen anything like this since, I think, 4 years when I saw.
I love it. I love it.
The bulls went from 35 to 19%, and the market's like cracking new highs. It's like
right, which is why I think which is why I think it could go higher. I mean, it's hilarious. This is the most hated rally in history, and everybody that said sell has egg on their face right now, and that's what you get for being a lemming, is what I would say.
I mean, another interesting point that's something that I don't usually think of was, like, I was just taking a step back and thinking, obviously we all know what this rally is all about. It's about reaching for yield. It's improving macroeconomic figures. The fact that there is some degree of better data coming out, both private and public, and especially in the private, unemployment is high because productivity is so high. You don't need to hire that extra guy because the technology or your operational processes have become very efficient. I mean, the United States is one of the most efficient countries in the private sector that way. So you look at all this and you go, okay, fine, everybody thinks that, you have to reach for yield some way or the other, which is how this market keeps going up. And there's another factor. And when you look at as a product, or, if you take all of equities as an asset or a product, you go, okay, so I'm going to compare just equities to bonds. You realize that actually the amount of equities available to you as an investor is, even though the market is back up to its highs, let's say 07 highs, the difference between the number of equities you could buy in 07 versus now, by that I mean actual number of shares, is stark. It's down by 30%, I believe, or some ridiculous number like that, which is because a lot of these guys have been doing buybacks. So there isn't as much supply of equities either, right? That's, again, a supply-demand issue. I mean, a 25% move in the world's largest, market is a big deal. I mean, so many buybacks have happened, so many companies have gone out of business, so much has merged that, dollar for dollar or pound for pound, whichever way you want to look at it, there just isn't enough equity for that dollar or for that pound left to buy. So that could be something else. It's just, I could be completely wrong, but it's just something that I observed as well.
Well, Shreyas, we do have to keep on rolling with our final segment. I do want to thank you for coming on the show. And before we go, if some of our listeners are interested in contacting you or perhaps speaking to you about your fund or learning more about your fund, where can they go to find out more about that?
You could go to satwiccapital.com or email me at Shreyas@satwiccapitalpartners.com. Those would be the best ways, I would think.
Great. And for our listeners who don't know how to spell Shreyas, it is Shreyas. You can never assume, I've learned on this show.
That's
so,
true.
Shreyas, thanks again for joining us. We're happy to finally get you on. It was a very fascinating conversation. We'll certainly have to bring you on again down the road to discuss some more of these developments in greater detail as they keep unfolding. So thanks again.
No worries. Thank you very much for having me, guys. Appreciate it.
All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to keep on rolling into our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. This is indeed the portion of the show where we all bring out our crystal balls and we peer into the murky ether of the future and attempt to divine what the Vol gods hold in store for us for the coming week. And it is an interesting time as we hit on at the top of the show. I think a lot of us, I haven't heard Bob's perspective, but a lot of us seem to feel that we've kind of found somewhat of our floor, at least from a VIX perspective, an implied vol, the S&P perspective. Who knows what the heck's going on with gold vol these days? I thought Shreyas made a great point about even if you worked out on the move, the skew still came back to bite you in the end, which is an interesting factor out there in gold, seeing that skew becoming so heavily distorted. Obviously, a lot of interesting stuff at work out there in commodity land. And Mark, you hit on commodities at the top of the show. Are you guys starting to do more commodities? A lot of your mentees and clients coming to you asking, hey, let's talk about GLD and SLV as well as the futures options?
I mean, it's always been that way. People want to know, kind of the entire option verse. So, when people are looking at this stuff, we tell them, learn options, then learn the product. People usually want to go the other way around. And
option verse, yeah. I like that. Can I coin that? That's on my new site.
You may.
The option verse. Options Insiders option verse. Okay, so S&P has a bit of a vol floor. What else are you looking at here from a vol perspective?
I think S&P's at a vol floor. I think you got to fade this gold move. And if you're looking to sell something, like Shreyas said, the rut has been overpriced for so long. So is the NDX. Both have been, it's like Apple and Google are. I had a client say this. He's a market maker. He says, it's like Apple and Google are conspiring to make the Nasdaq go nowhere. And that's kind of what we're seeing. If Apple, as soon as we see Apple and Google start moving together with some sort of positive correlation, Nasdaq's going to explode one way or the other. But until that happens, it's going to be spinning its wheels.
Now, you must have loved having Shreyas on the show today because he kind of confirmed something you've been saying for a while. I know you've been espousing that whole downside puts are expensive, but when you look at them in the massive move perspective, they're actually underpriced. What he is saying today kind of makes it sound like that's a more viable strategy, at least in the recent near term here in the S&P. You could hold those positions a little bit longer, and it's usually I think the conventional wisdom is, that's a difficult road to hoe because you're getting killed every day on decay and gamma. But he made it sound like it's actually a little bit more viable. You could put that on in the near term and keep rolling it and actually do all right till the big pop hits.
Most people lean toward, leaps or longer term stuff like the OCC study, but this was an interesting one that, I was wondering when all of this constant kind of retail and fund put selling was going to have an effect on kind of downside hedges, and it's interesting. I think we're starting to get there.
I was thinking it was the histrionic and hysterical buying that was keeping them inflated long enough to keep the decay at bay, at least until you can make the move to pay for holding that position for so long. Either way, interesting stuff. I think that's worth more study on that particular event because that's something that I think contradicts what a lot of us would have assumed. Bob, what is catching your eye? What are you looking at? What are you thinking about from a vol perspective going forward here?
Well, first I'd like to comment on what Mark said. I think that you need to learn volatility first, then go to Mark to learn options, and then go to the rest of the market.
I agree. There you go.
Spoken like a man with no skin in that game whatsoever.
So, and yes, I really was very interested in that weekly option analysis. I think there's a lot. I think the weeklies are getting very efficient, by the way, because I think there are a lot of sellers in there trying to, capture that huge decay that he's talking about, that you lose 20% a day kind of thing with the time decay of these weekly options. And everybody's trying to jump on that. Well, when everybody does it, that's not such a good thing, so to speak. And so, there are very, let's say, fewer buyers of options that decay like that. And so, I think the weekly options are getting to be very efficiently priced, and there's not too much, play there. And it may be actually a very good short-term hedging vehicle, especially for events. If you're worried about something happening in the next few days, kind of thing. So I'm very excited and interested about the efficiency of the weekly options.
That's something we've hit upon a couple of times on this show and other shows on the network, that you're right, they are becoming a little bit more efficient. And there are indeed some opportunities where those premium harvesters, those theta harvesters really overdo it, and you can get a nice little free period of speculation, some free gamma, maybe even a nice little pop on some of these weeklies if you time it pretty well. We've talked about that before, that pop they get a lot of times coming out of Thursday going into the Monday, that where people just crush them going into the weekends, well overselling these things to dramatic levels. And there's a lot of times where if you pick your timing pretty well, you can actually fare pretty well. Like I said, I'm glad Don's not here to hear that. So I'm sure somewhere in Paris right now, his ears are burning. He's saying, wait a minute, who's talking about long premium on my show? But yes, interesting stuff to look forward to. Of course, a great guest. We want to thank Shreyas for joining us today. And of course, I want to thank both you, Mark, and you, Bob, for joining me on the program today. And before we go, why don't we peer behind the curtain a little bit and see what you guys have cooking in your respective necks of the woods? Starting off with you, Mark, what is cooking in the land of the pit?
Let's just talk about what you and I are doing together, because I think that's the most important thing. I'm going to be speaking at the Option Insider Unusual Activity Forum on May 15th. We're going to be giving out copies of my book to the first 50 people that sign up. So if you are not, and which is cost $50. So if you don't want to pay the $99 to join, and you get a free $50 book and a bunch of other swag, then you are beyond short-sighted. Yeah, we kind of gone
overboard on the value proposition here on this thing. We're charging $99.
Ridiculous.
We're charging $99. We're giving away your book. We're giving away your, of course, Option Pit Live, which I think is what, $150. We've got the trade alert stuff that's worth about $150 a month. Option Live Vol Pro alone is $200 a month. We got mentoring stuff. It's really kind of crazy how much stuff you get. And you get a floor tour, and you get all the stuff we're going to talk about. A bunch of sessions about how we do unusual activity. So not to toot our own horn, but since Mark got the ball rolling, if you are in Chicago on May 15th or plan to be anywhere in the area, we would love to see you down there at the CBOE. Surf on over to theoptionsinsider.com/events to find out more how you too can get in on that ridiculous bargain, $99 for all this stuff. I wish we could do it free like we do for everything else at Insider, but of course there are costs whenever you put on an event, but we like to really make sure you get a ridiculous bang for your buck here at Options Insider, and I think we have done so with this event. So May 15th at the CBOE, be there or be quite sad you missed out on this ridiculous event. And Bob, I know you can't make it in Chicago on the 15th, but what is coming up in the land of Volex?
Well, I might have to adjust my plans because it sounds like I could even get the airfare paid for.
Such value. How could you turn down such value?
So, it's taking much longer than we thought. I mean, we've been talking to our potential investors for the longest time, but everything still seems to be moving. I think we're going to be, closing on some deals soon, and I hope everything gets together and we'll be able to launch in the fall. But we've pushed back this target for several times now. So I don't know what to tell everybody. We just keep plugging away. We keep working, and we're getting closer. But I hope it happens soon.
Well, a bit of a sour note to end on, but nonetheless, there is some hope, some optimism there that we will see these NASDAQ products sometime in the near future. I know a lot of our listeners are very keen on getting their hands on those and trading some real vol in NASDAQ as opposed to all the implied stuff that's floating around right now. So they are very keen to get those listed. So hopefully we'll see those sooner rather than later. And speaking of listeners, of course, all of us here on the Volatility Views panel. Want to thank all of you out there in the listening audience for downloading and streaming and subscribing and writing in with such great questions. We didn't get to any this week, of course, because we had a guest, but we'll get to the mailbag again next week. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.